Right guys, welcome back to the channel. This is the fourth and final video in this series on trading journaling, and I want to talk about discretion in this one. If you haven't already seen the last three videos, you're going to want to go and watch those first. Otherwise this one, this is the one that you want to apply last basically. A lot of people feel like you can just put your finger in the air and take trades because you get a feel for the market. That's rubbish. I've never met a purely discretionary trader generate consistent profits over any decent amount of time consistently. So what I'm about to share with you is what you have to earn and how you can logically measure your discretion level and how you can build aggression onto your trading, which every trader wants to be more aggressive because ultimately you want to be able to get involved with more trades and have higher probability and make more money, right? So that's what this process is going to show you, and I'm going to walk you through how I do that and things that you're going to want to take into your own trading so you can become better. But if you haven't watched those videos, go and watch those first. So I'm going to share my screen here, and the first thing I want to show you is this weekly aggression discretion tracker that I use. And all it is basically a series of columns that I fill in so that I can measure and do something with my predictions and my aggression, right, into the trade, so I can get more opportunities ultimately. And the things made up of, first of all, the market. So the first thing I recommend you do is every day just write down each of the markets that you trade in the column, in the list. And by the way, if you stay to the end of this video, I'm going to be sharing with you a way to get your very own aggression discretion tracker. So make sure you stay to the end. So get into the habit of putting all the markets in a list, and then the next thing is a prediction, a daily prediction. And all you're doing here is you're having a bias. You're making a prediction. You're not doing anything with it. You're not trading based off of a prediction, you know, a guess. You're just basically noting down whether you think that the market's going to go short or whether it's long. And at the end of the day, you review that, right? And at the end of the day, you start to see how many you were correct on. Okay, so you can trade alongside doing this. This isn't something that's you need to stop trading and do this. This is now you're trading and you're journaling and you're a professional trader. Now you just start making daily predictions. You start seeing when you were correct and when you're not correct. Now you can see in this example, I was right 1, 2, 3, 4, 5, 6, 7, 8, 9 times in this particular week. This is a week of trades. I was right 9 times. Now that's interesting, right? That's a good prediction rate. On the next column, you can see my entry criteria. Now what that is whatever trade system or strategy that you're trading, is the entry criteria met? Now you'll see that on six of the trades here, my entry criteria was met for that particular short or long position. Okay, now you'll notice on the next column is the P&L. So that's basically what percentage you gained or lost as a result of taking those trades. Now in this particular week, I made 4%. Okay, so 1% per trade on this particular swing trading strategy on the daily time frames. And by the way, I teach you guys that in my 30-day trader challenge. And the idea of that is to get you from 0 to trading live professionally in 30 days. And if you haven't seen that, you can check out the link in the description and join me for that. That's going to be the best next step for your trading. Rather than going around all the books and all the kind of thing, go and do that, and that will get you from A to B as quickly as possible. So the next thing is the P&L. Now you'll notice that in this P&L column, I've got 4%, 4 of the trades, and that's because I could only take 4, even though my entry criteria was met 6 times. Now, why would that be? Well, if you look at some of the pairs, you'll see that there's some correlation risk there. On some of the ones that I couldn't take, I was already in a euro trade, or I was already in a pound trade. So I couldn't then take another one because that would breach my correlation risk on that particular strategy. Okay, now it doesn't mean that I can't do that forever. That's the whole point of tracking this stuff. So now we can see, right, I was right 9 times on the direction. My entry criteria was met 6 times, but I only took 4 trades. I could only get in 4 trades. Well, then I'm leaving some money on the table, right? And I'll explain more about that in a minute. Now, the next column is basically on the ones that my entry criteria was met. If I took different target positions, what would have been the percentage return if I'd taken those different targets. So I have different target positions. I have a 1-to-1, and then I have I have a structure-based trade. Then I trade to the close of the candle or the high of the candle. I can trade to extensions on some of my setups. So the idea is you've got these different target levels that you're testing, and you say to yourself, okay, well, I was out of the 6 entry criteria that were met. Had I taken all of those 6, what would have been my gain had I taken all of the different target levels? And you make a note of those. So you can see what we're doing here. We're really like forecasting and projecting a realistic performance gain based on what's actually happening, what our level of discretion, real discretion, that we can predict what's likely to happen. And then we're measuring how often we're correct, when our entry criteria is met, what different targets would make a difference to what our current performance is, and you get the point, right? And then what happens is you've got all of this analysis to say, okay, well, I got 4% on this week, but I actually, if I'd taken target 1, I would have got 6%, and if I'd taken target 2, I would have got 8.29%. I would be up 8.29%. So what that shows is I'm leaving money on the table, which I could actually put in my pocket if I increase my aggression. Make sense? And my discretion. So that's why I call it aggression discretion. So down the bottom, you'll see that it actually gives me a percentage in which I can raise my aggression level. So on target 1, I can actually become more aggressive to the tune of 1.5%. On target 2, I can become more aggressive to the tune of 2%, right? Now, in reality, would I actually look at this after 1 week and go, yep, I'm going to raise it up 2% more aggressive? No. I'd probably go to 1%. I'd go half. And it's the whole thermostat analogy. Anyone who's, seen the on-off thermostat where people go, oh, I'm a bit cold, let's turn the heating on, and they whack it up to 30, and then they go, oh, I'm too hot, let's turn the heating off, and they whack it down to 0. Right? Instead of just tweaking until you're very, very comfortable at that 21.5 degree level, right? Where you can work in a workshop and not build up a sweat, or you can work at a desk in an office and not get cold. That's all about fine tuning and tweaking, and so that you're not doing these oscillations. You don't want to do too much at once, because then if it's just a lucky week, then, that's not going to serve you going forward. So I would say that you want to do this and then assess it weekly, but only make changes after 3 months or 6 month periods when you do your final review. That makes sense? Now, that's one example. I've got many, many ways that I can go into this and drill down and explain each of these columns in more detail, and maybe I'll do that in a later video. I'm also going to do a video on the journaling platforms, which you guys have requested. But another way, just before I finish up here, that you could use this is literally just for how often you're correct and how often your entry criteria was met. So you can still do the market, the daily prediction, look at how often you're correct this week, and then how many entry criteria are met. And what that will do is that will highlight maybe you're being too conservative on your entry criteria. You might actually be leaving money on the table because you're waiting for a double top, or you're waiting for too many filters, when if you just strip some of those filters back, actually you might get involved with more trades that are higher probability. So you can just compare those two columns and just use it for that. So many, many ways that you can actually use this to actually get better trading results, rather than just thinking you're some discretionary trader that you're getting reps and you're having a feel for what the market's doing. No one knows what the market's going to do. Okay, this is a solid way of building discretion into your trading and becoming more of an aggressive trader, whilst capturing more wins, being more profitable, and being a better all-rounded trader. So I hope you enjoyed that. Let me know in the comments if there's anything you do to build discretion into your trading in a logical way like this, that's actually forecasted and measured, because remember, what gets measured gets mastered. And until next time, guys, remember to check out my 30-day trading challenge, and until then, take care, and I'll see you on the next one.